To another edition of Market Takes. I'm your host, Dion Rabouin. An exciting but very interesting jobs report today. We are obviously breaking that down, the December non-farm payrolls report. I'm going to be digging into all that, explaining just what we saw in the report, what we learned, and what this means for the markets going forward. We're also going to talk about the market reaction, all that good stuff. So a lot to come here on Market Takes. But before we do that, I want to say I know you could have been anywhere in the world, but you're here with me and I appreciate you. So thank you for tuning in to Market Takes. So we're going to break down what the report said, get through all the numbers, talk about how it compared to expectations. We're also going to talk about, obviously, the market reaction, stocks, bonds, currencies, commodities, all that good stuff, and what that tells us about how investors are breaking down and understanding this report. Of course, we're going to get into understanding the Fed, and coming into this report, what the Federal Reserve makes this report was really the most important thing. Much more important than what it says about the economy or what it says about the future of jobs was how the Fed interprets this report. And I think there's some very interesting reactions in the market that we can sort of look to see what investors think about what the Fed thinks about this report. Of course, we're also going to talk about those investor expectations. And then, I never leave you without talking about what to look for next. Because, as investors, we're not looking backwards, we're looking forwards, even though we got the backwards looking data. So again, thanks for tuning into Market Takes. I'm your host, Dion Rabouin. Let's get into it. So first and foremost, the December jobs report showed the U.S. economy added 223,000 jobs in December. The unemployment rate falling to 3.5%. Now, that's usually just kind of a technical indicator, not something that a lot of folks on the investment side watch, but this report showed some very strong numbers, and we're going to talk a little bit about that in just a minute. Now, that 223,000 jobs added number was above the expectation for 200,000, so not a big beat. We saw the ADP report yesterday that showed 235,000 private jobs added. That really sank the market because folks were saying, oh no, the Fed's going to have to do more. We're going to have to see more rate increases, more rate hikes from the Fed, a tighter economy. Stronger for longer, higher for longer, all those things. This report was better than expected, but there were some details within it, which is why we got that initial pop in the market. Stocks initially jumped higher, and then you're seeing kind of a comeback right now. So I'm going to explain all of that. Listen, 2022 was a very strong year for job growth. Employers added 4.5 million jobs throughout the year. That is the second strongest year on record going back to 1940. So a lot of jobs added, a strong job growth year. That's normally a good thing. However, the stock market obviously did not reflect that. We saw big time turndowns. Now, the biggest piece of this report, I thought, and when you're looking at the market reaction and when you just kind of understand what's really important, what are the pieces to dig through, what are the details, it was this average hourly earnings number. And average hourly earnings is the thing about, how much wages are rising. And the Fed has really signaled that out as they say, wages are rising too fast. That's not a sign of a strong, healthy economy. That's a sign of an economy that's going to keep being inflationary, that's going to keep pushing prices higher. We want that number to come down. We need we need the labor market to get more in line with traditional years of wage growth. Now, the average hourly earnings number missed. It was below expectations, 4.6% year over year growth, and 0.3% month over month. That's lower than expected. That was expected to be 5% year over year and expected to be about 0.6% month over month. So that's actually lower from November, and November was even revised lower. So you're seeing what's not necessarily good for folks who have jobs out there, who are trying to get that next job, who are trying to bolster their paychecks and keep up with inflation. But that is good in terms of if you're an investor looking at what the Fed's looking at and saying, okay, this wage growth is coming down. We've seen inflation overall, the CPI, Consumer Price Index, has consistently kind of come down since that June peak at 9%. And in November, it was at 7.1%. So along with inflation coming down, we're seeing that wage growth number come down. Average hourly earnings now well below 5% at 4.6%. That is a big time number. Now, when we talk about that unemployment rate, 3.5%. Well, that generally came from good news. We saw newly unemployed, a lot more folks coming into the wage force, but a lot of folks who were unemployed coming back. Unemployed, the number of previous unemployed people fell by 278,000, and new entrants to the labor force increased 439,000. So we have not seen a lot of those folks coming in from the sidelines, as they say, folks who weren't looking for jobs before, now looking for jobs, looking for employment. And we are seeing that start to pick up. Also, a lot of those people who were unemployed, looking for jobs, they're finding jobs. And that is what's pushing down that unemployment rate to 3.5%, again, near some of the lowest levels it's been in the post-World War II era. That's a big deal. So listen, when we talk about all this, as we know, it's all about what the market's telling us. And the market's going to tell us a lot about what the economy is going to look like and what matters and what to look for going forward. So as we look out at the economy, I'm checking out WSJ.com right now. The Dow is up 0.7%, S&P about the same, the NASDAQ up about 0.3%, excuse me, not 3%, 0.3%. You were seeing initially stocks really jumped out after that, the jobs report. Jobs report came out at 8:30. We saw the stock market open at 9:30, just kind of went straight up, and then it came basically straight down after that opening. I think a lot of folks kind of selling, maybe seeing that this report showed more jobs added than expected, keeping the trend in line with what we saw from the ADP private payrolls report yesterday, as well as the initial jobless claims report yesterday. Those both showed less layoffs and more hires than had been expected. But this report, with that average hourly earnings number, stock investors are saying, okay, maybe this gets the Fed to take their foot off the brake a little bit. The Fed has really been stomping hard, pressing that brake, trying to get the economy to slow down. And now this sort of changes the course of what are the expectations for the Fed's December meeting, or not December meeting, excuse me, what are the Fed's expected course for the January meeting, as well as meetings through the rest of this year, and whether they need to raise it 50 basis points like they did last month, or you know, maybe moving back down to 25 basis points, going at that level that they raised rates at really over modern history in the past 15 years. They have traditionally only raised rates at 25 basis points. Remember, we got 4 increases of 75 basis points last year, and then another 50 basis point rate hike in December. So there was a very clear bias by the Fed to raise rates significantly and keep them higher. That's what they've said they're going to do. Well, stock investors are kind of excited because this report maybe gives the Fed an excuse, and some of those so-called doves on the Fed who are more worried about unemployment, who are more worried about folks losing their jobs, and more worried about the economy being strong than they are about inflation getting too high. This gives them some ammunition when they're in those meetings, when they're talking to Fed Chair Jerome Powell saying, hey, look at this. Average hourly earnings are down. Average hourly earnings are coming down, exactly what we want to keep inflation in check. And that's a reason why maybe we don't need to do too much. When the Fed kind of relaxes, lays back a little bit, the economy is able to grow more, and that really boosts the stock market because folks are able to borrow more money. When you can borrow more money, you can put that money into stocks, and stock investors like that. So the other big piece of this, though, you got to talk about bonds. We got to talk about bonds. If you know me, you know I love talking about bonds. The bond market is really where we see the true market, if you will. You know, the smart money is really in those bonds. So as we look at it, the 10-year yield, that's the most traded in the bond market. We saw an initial, decline in yields, which means prices go up, right? So a lot of folks were buying those bonds after this report came out. But since the report has come out and since folks have had a little bit more time to kind of analyze and look into it, you're seeing a little bit of that come off and then boom, right straight down again as folks looked at it even more. So the 10-year now at about 3.63%, and you're looking really across the board, the 10-year, the 7-year, 5-year, all the way until you get down to that 3-month bill. And that was the one place where we saw yields kind of pick up, which is the expectations for immediate action by the Federal Reserve. Folks saying, look, this isn't going to deter the Fed from raising rates immediately in January, maybe the first quarter of this year at their meetings. But we think overall, this sort of gives them an excuse to maybe lay back, maybe do a little less, maybe not raise rates quite as much as they've tried to convey. And really, the Fed has said very clearly, we need for markets to not be buoyant. We need for rates to be lower. We want the stock market lower. And when folks respond in this way where they're buying stocks, they're pushing prices up, they're pushing bond prices lower and pushing those yields higher, that's the opposite of what the Fed wants. Also, when we're looking out at commodities, I thought a very interesting reaction was what we saw from oil prices. Oil prices really picked up strongly, up about 1.5%. They've now cut that in half or a little more. Crude futures, WTI and Brent are up about 0.7, 0.8%. Gold still up strongly. Again, a lot of these things kind of shot up after the jobs report and are now coming back down a little bit. Silver is still up about 1.5%, a big move from silver. As we look out at the currency market, the dollar is down. The euro really took off after that jobs report. Again, showing that average hourly earnings are coming down. That is an expectation now that gives folks the expectation that the Federal Reserve won't have to do as much. And when the Fed doesn't raise rates, well, that makes the dollar less attractive, makes other currencies more attractive. So the euro really taking off, the Japanese yen getting a boost, the British pound getting a boost. All these things, not a huge move. We're not talking 1%, 2%, but a 0.5% here and there. All these currencies have moved about a 0.5%, but all basically in the same direction. Dollar down, other global currencies going up. And when you look out at crypto, let's see what we got going on in the crypto market. Well, crypto still down, but really pretty flat. Bitcoin down about 0.5%. Ethereum, very little moved, about up 0.01% on the day, or down 0.01%. So when I talk about the Federal Reserve, right, and we're talking about the Fed and Fed Chair Jerome Powell, they have really been laser focused on the labor market. They haven't talked much about corporate earnings, corporate profits, corporations raising their prices. They've really talked about labor. And when the Fed does that, what they're saying is when more folks demand raises, when they're getting higher wages for moving jobs, things like that, which is what we saw throughout 2022, well, then corporations raise their prices. They say, hey, you know, our workers are asking for more money. To make up for that, we've got to raise the prices. And so the Fed has said, listen, as long as these average hourly earnings are rising, as long as wages are increasing significantly and much faster than our 2% target, that's why we'll need to do more to try and get the labor market back in check. One thing that's been really interesting is that earnings, those average hourly earnings, have not come even close to inflation in CPI. So as we saw CPI at 9% back in June, we saw average hourly earnings at about 5%. And now as we're seeing CPI at 7% for November, we're seeing those average hourly earnings at 4.6%. So you're still seeing a gap. It's kind of lowering as inflation overall comes down and gets closer to that wage target, but wages are still well below the overall level of inflation. Now, when we look at the not the price target, but as we look at company margins, average profit margin for companies, that's the highest it's ever been. Companies are making the most profit on everything they sell. When you look at the average profit margin number on the S&P 500, that's at about 13. That's some of the highest levels we've ever seen, which means companies, for every dollar of sales that they do, for everything that they sell and they make $1 on, they're getting about 13 cents in profit. Now that number changes depending on wages, depending on what they're paying for inputs, but what we have seen is consistently the amount of money that companies are making for everything they sell has been rising, their profit margins have been increasing, and a lot of folks have said that's what's really the problem here with inflation, is that we're seeing those profit margins rise and companies are making a lot of money. You've got a lot of economists right now, folks from the left, the right, the center, people like Nobel laureate Joseph Stiglitz, Wharton professor Jeremy Siegel, economists at the right-leaning American Enterprise Institute, at the left-leaning Economic Policy Institute. They're saying, hey, listen, the Fed is making a mistake. They need to stop raising rates so aggressively and choking off the economy because they are going to needlessly cause a recession. Well, the numbers that we got today really kind of support that, you know what, wages are starting to come down. They're not coming down super fast. They're still much higher than the Fed's 2% target, but 4.6% wage gains compared to 7% inflation, you're still not really winning. And when you look at real wages actually decreased all of last year, 2022, because they were far below the rate of overall inflation. So that's why folks were looking so much at this jobs report, because the Federal Reserve has said it's jobs. Jobs are the problem, wages are the problem. People are increasing their wages. There are too many unfilled jobs for the number of jobs out there. It's almost 2 to 1. For a while, it actually had been 2 to 1. There were 2 job openings for every unemployed person here in the United States. And the Fed has said that's a problem because that's going to keep wages going higher. We saw the JOLTS report earlier this week that showed that there have been an increase in job openings, a decrease in the number of people hired. That means that those jobs are still, there's less competition for those jobs, which means employers have to pay up, which means they'll pay more, which means inflation can keep rising up higher. This has been the big thing that really we've talked about in terms of looking out at the labor report, looking at the labor market, and looking at this jobs report. Investor expectations have been for the Fed to raise rates this first quarter, as they've said, then kind of keep them high through the second quarter. And then a lot of investors are saying either inflation's going to start coming down and the Fed's going to cut rates, or the US is going to enter a recession in the second half of the year or late in the year, and the Fed is going to have to cut rates in order to deal with that. Now, Fed Chair Powell said very clearly, I'm not going to cut rates. We need to keep rates high because inflation is my #1 target. My idol is former Fed Chair Paul Volcker, who raised US interest rates all the way up to 18, 19% in order to beat back inflation, put the country through a painful recession. That's what Jerome Powell said he wants to do. You've got these economists saying you don't need to do that. And now with this jobs report today, well, that's another little bullet in the gun of some folks who say you don't need to do all that. So listen, that's the big picture of what we're looking at with this jobs report. It really is all about that average hourly earnings number, and we'll see if there continues to be some bullish momentum, because that does kind of fly in the face of what the Fed has been saying. They've said, we're going to keep rates high because we think that that earnings and wages are too high. We need to get them back towards 2%. 4.6 isn't really that close to 2%, but it's down from 5% and it's well below the overall rate of inflation. So listen, here's what you need to look out for coming up next. We've got the Employment Trend Index report coming out on Monday. Now, that's not something a lot of investors watch closely, but it's something the Federal Reserve will certainly be looking at. Look at that number. Investors want to see this number continue to fall. It's been falling over the past few months, and if it falls again, that could be really good news. You could see a pop in the market. Also, we've got the November Consumer Credit Report. That is already at a record high. That was a record high for 2022. We'll see if 2023 Americans stop taking on more credit, less, if they keep taking on credit card debt, keep borrowing money from the banks, personal loans, all that, because it's really starting to get to a level where credit card interest rates are already at the highest they've been. Mortgages are some of the highest they've been in 15 years. So do people keep taking on more credit, borrowing more money? Because that's going to really leverage folks up. And if the economy takes a turn, it could be a problem. And of course, CPI, the Consumer Price Index, that is going to be very closely watched, especially after this jobs report. We will be right here on Market Takes, breaking that down for you, telling you all about it. So be here with us on Thursday. Don't be that's a square, don't do it. We will be here on Thursday, Market Takes. I hope you'll join us. Listen, that's going to do it for me. I am Dion Rabouin, your host here on Market Takes. Thank you so much for being with us. We're going to wind it down now. I know you could have been anywhere in the world, but you were here with me. And again, I appreciate that. Thanks a lot for being with us right here on Market Takes.